Hello, good afternoon, and welcome to the Sales Scoop. This is a live show for tech startup founders who want to improve how they sell. My name is Alistair Cole. I'm your host for today. I'm a computer scientist, an ex-software engineer with 2 decades experience in B2B sales and marketing. And I'm delighted to say that I'm joined today by Kieran Gill, B2B sales expert and startup co-founder. Hi, Kieran.
Hi, Alistair. Hello, everybody. My name's Kieran. I'm also a co-founder of the Uplift Partnership. I have 25 years of experience in frontline sales operations and in complex selling in tech and in finance.
Thank you, my friend. So today's topic, really exciting, from seed to Series A, demonstrating growth, how startups need to show how they've grown to secure that Series A funding. And for me, Series A is all about demonstrating that there is sustainable product market fit. You've got to show investors that people care about your product and are prepared to pay for it. Kieran, what's your feeling in the market at the moment for what's happening with funding, in Series A, but also in seed? What's happening in the investment ecosystem out there, my friend?
Yeah, looking into what's happening out there in the world of finance, there is an increase in 2024 in financing at Seed A or Series A from seed. So there's a lot more financing money going in. Currently, I think the numbers are looking around about 16% up in Q1, increase from 2023 to 2024 Q1. So that's a really big increase. 16% is quite a lot. And of that, that's around about 23 billion euros have been invested into Europe in the first part of this year. And over 32% of that has been invested into the UK. So that outstrips both France and Germany put together, Alistair. Now that's impressive numbers from the UK startup scene. So the money is out there and it has been invested. There's some great success stories that have been around. So there are startups picking up, from 100,000, 200,000 here. There was one recently, Viability, who is a building platform for construction sites. And then going out to the bigger ones, one called what was it? It was Contact. They are an AI data platform, and they picked up £23.4 million worth of investment. So the money's out there. So it's time to get moving.
Yeah, to get Series A, you've really got to have made big progress traveling down the path from an idea to a functioning product that people are going to pay for. Impact is needed. Talking about our impact over the last 5 years working with startups, we've helped them improve their clarity around their sales, which increases their confidence and their win rates. We've demonstrated solid ROI, and crucially reduced stress and increased happiness for tech startups. So that's our impact, and fantastic to hear that news. It does feel like the climate is changing. There is money out there. We've been helping a lot of our clients go after bigger enterprise deals as they seem to be spending a little more. So that it does feel like it's going the right way. If we dive into this topic of funding, we've put we see the early stages of funding in this way. Pre-seed is first, then seed and Series A. The Series B and C. But Kieran, maybe you could talk through how you think about the kind of areas of focus for startups in these different rounds and the activities and turnover that they've got. Talk to us about a pre-seed. What's happening in that area, just for clarity for people on the call.
Okay, so pre-seed, realistically, if you're in this stage, is that your product's probably in its first kind of iteration, maybe the second iteration that it's gone through. You're pretty much finding out whether the market actually wants your product, whether there is a market for your product, whether your idea is out there and can make a difference. and is it fundamentally going to, generate sales? Because before you even start looking at investment, that's what the VCs or investment houses, wherever you're going to go and get money from invest, that's the question I would be asking. I was a corporate bank manager for many years, and I would look at business plans, and that's what I would look at. It's what you're doing, being successful for us as members, to do money, to make sure that we get our money back. What we expect. What VCs are interested in, they want to see profit. They want to see acceleration, and they want to know that they're putting their money into something that can go. So that pre-seed section really is for you as a founder to get those first early sales in. Prove that your business is actually doing is viable, that there is a market out there for you to get those first lot of sales in, so that you can then go to wherever you're going to go and raise money from to say, you know what, we're making money. Invest more in with us, then we can take our business, we can supercharge our business to the next stage.
Yeah. Okay. Helpful. And then, what about where we're focusing today? What high level things should people be thinking about in that Series A round? How would you describe that?
Okay. So if you've got to seed, that means you've got a viable product and something's working for you. Now, the golden rule is if you're going to be going for Series A, and it's not a golden rule, it's a rule of thumb, the number that keeps being bandied around is around about £1 million or $1 million, €1 million, whichever way you want to look at it, of sales coming in, turnover, coming through the business, that's showing that you have got it. Now, that's minimum, I would say. Once you hit that golden number, you know that you're ready then to start looking into getting investment into the company to accelerate you from seed to Series A. Now, remember, this is where this is serious acceleration. That acceleration there is going to be mainly about sales and marketing, and it's going to be about pumping in and making sure. At this point, your product might be being redeveloped. You might be doing some tinkering around the back, but tell you the truth, the vast majority of the money that you're going to be bringing in is going to be about accelerating your sales and your marketing operation.
Yeah, absolutely. And it's critical for investors that they can see the return they're going to get, right? They want to know that this is an entity that can scale, right? And it comes down to unit economics. Does that make sense? For every dollar they're putting in, how many dollars are they going to get back? Because obviously, the better the metrics are in terms of those unit economics, the easier it is to demonstrate growth and hopefully for them to generate a return. We've picked out a number of our favourite investment metrics. You can go and get more online. It's kind of an inexhaustible number of metrics you could pick, and we've got 4 that we want to get into and cover off today. Before we dive into those, I just want to explain that we're doing something a little bit different this time. We're going to be taking questions throughout today's session. We'll cover off at the end anything we don't get to. So if you've got any questions as we go along, fire them into the comments on LinkedIn, and we will get to them at some stage, I hope. So that's the question side of things. So Kieran, my friend, on here, what you know which 4 we're going to cover. What were the big ones on this? The big investment metrics in your opinion?
Okay, so remember, we're looking from a point of view of an investor. Let's call them, a VC, just for argument's sake, a venture capitalist. What they're going to be looking for are key metrics to show them that your business is successful where it is at the moment. They might not actually be even interested in your idea. Not always. If they're a true investor, what they want to know is, are you making money, or are you going to be wasting their money going forward? So if you look at these ones, the major one is looking at something as activation rates, tells you that your product is being used by other people. Now, that activation rate might be a top line number, and it should be then going into the actual metrics of how many people are actually then paying for that product. But the activation rate might be great to show people, look, the freemium version, we've got X amount of downloads happening. People are going on there, they're hanging around. However, there might be a problem from going from activation going to paid. Yeah. And again, from a VC point of view, that might not be a red flag. That might be an amber flag. in the sense of saying, hello, they've got something that people want, but they're having problems taking it to the next level. So that's a
Yeah.
really interesting metric, and it's a metric I would be definitely looking at for a tech startup that is in that world where, they are doing activation rates, where there is a
Yeah.
premium. However, if your product doesn't have a freemium, activation rates aren't going to probably be something that I'll be looking
Yeah.
at.
And so that's an interesting area to look at. The four big ones that we've picked today that we're going to dive into now in some detail are these four: annual recurring revenue, customer acquisition cost, lifetime value, and churn rate. The four of the really big ones on here. We as Kieran outlined, activation rate really important, burn rate too. Gross margin ultimately is what it's all about, and NPS is critical in terms of whether people would recommend your product. The four we're going for are these four, and so we're going to fire straight off and get into annual recurring revenue. Now, a lot of the startups we work with, they charge subscription, they're SaaS based, and it is monthly, but you can see fluctuations in months, and so looking at a compound monthly is interesting too. But we've picked annual. Why are we coming out the gate with this as number one, Kieran?
I think it's just a ballpark understanding of whether you've got a business that's making money or a business that's not making money. That would be my first question. What's your turnover? Now, I know that turnover tends to be, as the old saying tends to be, turnover is insanity, in the sense of, is vanity, and profitability is sanity. So the profit is actually what really matters. But tell you the truth, the vanity of saying that you've got a business that turns over £2.5 million, that's nice. Okay, doesn't really help if you're burning £300 a month, £3 million a year. You've got a loss-making business there. However, people normally talk about turnover. So the annual recurring revenue is really interesting from a business point of view, because as a VC, it gives me an understanding of, is your business making money? Have you got money coming in? I would then go one step down to go to the monthly recurring revenue, because I want to understand whether the business is making money month on month, which months are good, which months are bad, why could that potentially be, and I'll be going into those. This, again, I probably would marry this up with the burn rate to understand how much money you're spending at the same time. Now, at an early stage, or a company in its early stages probably is burning more money than it's making, because that's where the risk factor is. There's development money, there's all this happening. However, there's a lot of startups out there now that are bootstrapped, that are making money and can show profitability even at this stage. And tell you, if I was an investor, that would interest me.
Yeah, absolutely. And it's almost that transition. It's hard to demonstrate predictable revenue, right, on a monthly and yearly basis. That's why AR is so important, because it is that predictable income. And sometimes startups fail to, or they're unable to demonstrate that kind of ongoing income, and that then, for an investor, that's going to lead to concerns about longer term viability, right? Which is why that kind of sustainable revenue is so important. Let's I'm keen to get into the others, but how do you like to get that information from startups that we're working with? Kieran, what are your recommendations on either how that's tracked or how that information needs to be wrapped up to be shared with investors?
So obviously, if you're putting that into a CRM system that can be tracked, and I've got a single source of truth, as we always say, is the best place to be. Because if it's been written on a spreadsheet or somewhere else, obviously your accounts are going to be showing those numbers as well. So it's a very simple way. As an investor, I'll be going through your accounts with a fine tooth comb. And I used to love doing that as a banker. That's all I did. And you see anomalies in there, and you can see whether there's truth. So if somebody's showing you a projection of something, and they're showing you their business is going to be turning over this, realistically, your accounts are going to be showing me a similar kind of picture. Now, you will have forecasts, you will have mini accounts that you can show, the investors to say, look, this is where we are. Here's a snapshot of our first 3 months. These are our sign-up rates. This is what we're doing in turnover. This is a great way to actually verify what you're actually showing to the investors. This is where we're going. What I also want to understand from an investor's point of view is what's the forecast for success going forward. So your annual recurring revenue is what you are doing now. That's recurring. I also want to understand what's going to be happening in the future as it goes along. Because remember, from a VC's point of view, and if I'm an investor, and let's go one step back, where does the VC get their money from? They're getting their monies from institutions or individual investors who are spreading their risk along many different investment vehicles. A VC is just one way of investing money. Now, a VC for me is personally a high risk entity, mainly because you don't know whether these startups are going to be successful or not. However, as an investor, I'm happy to put 10% of my money in there. But I might want to put 10% of my money into gilts or bonds or into other investments where I'm guaranteed a return. They might be smaller returns, but I'm going to get my money back. So as a startup, this is who you're competing with. You're also competing with other startups, but you're also competing against other investment potentials. And tell you the truth, other investment property, stocks and shares currently is ridiculous returns on stocks and shares. Putting your money just in the bank account is ridiculous. And that's why you suddenly saw a massive drop off in investment in the last 5 or 6 years, mainly as interest rates went up. Startups just weren't any longer seen as a viable kind of way of making money. That's coming back. And the annual recurring revenue is a great way to show businesses, hey, you know what? You've got something here making money, or you've got something here that's selling. You need to look at us a little bit more in detail.
Yeah, thank you. That's super insightful in terms of AAR. In terms of demonstrating it and showing it to investors, you could argue that our recommendations would be the same across all four. And we recently did a show on killer presentations and how to share information. Ones that spring to mind, early ones for AAR, or the others, is about knowing your audience. So understanding who's going to be in the room and how you can tailor the demonstration of AAR or any other numbers to them. And there are lots of other tips that we're going to cover off later in terms of how to present generally to investors. So we'll get into that, and that's quite exciting. A kind of summary of our top tips. For startups looking to, if they feel like their AAR number is too low, Kieran, right? Ultimately, they're not generating enough income. Sales is one of the strongest areas where they can improve their AAR by generating more leads, closing more business, looking after customers in a better way, and upping your sales game, not just to improve performance in AAR, but also to get your sales house in order, so that when you are going for Series A, your sales engine is more professional, it's more robust, the numbers are stronger, and there's more confidence behind it, because confidence is really important. Is there one of the kind of our big 7 areas of startup sales areas that you would pick, from strategy all the way down to continuous improvement, that startups should be focusing on to boost their ARR?
Well, it depends on your. I think it comes down to the quality of your sales engine, and the part that always sticks out for me, working in complex sales, was the people that are selling your products. So, if you're selling something that is not a product that you're going to be selling over the net, or that actually is face to face, this is where you can really make a difference. Having a salesperson who knows what they're doing, that has all the material in place, that can go out to the market and actually talk to people confidently about the product and be able to get it across the line. Yeah. Selling 1,000 units to one customer is so much easier. Well, it's so much more profitable than selling 1 unit at a time, isn't it? And so I think that's your team structure is majorly important. At Series A, and this is what we're talking about here. At Series A, you should know what you're doing in your sales department, but you're missing certain components and maybe a few little things in your sales team just to make them start moving that extra bit to start making the really big sales, where you sell 1,000 units instead of selling 20 units.
Yeah. And that team structure, that is the second area that we've identified of 7 that is absolutely critical for startup sales success. Team structure. We'll come back to the 360 later. Thanks. Let's skip on to our second, demonstrable metric that is really key to bag investors. Customer acquisition cost, right? The cost of getting that customer into the business, so important. Obviously, you talked about additional costs exceeding ARR at the top of the show here. Talk us through a little bit about why customer acquisition cost is so important, Kieran, and what that means to you, and how it should be tracked and demonstrated to investors.
So customer acquisition costs is mainly everything that it costs to get that customer. So that's all your marketing, your salespeople, anything you're using, all the platforms, all the technology, and you need to put that all together. Now, obviously, when you start the business at the start, your customer acquisition costs tend to be higher because you're only winning customers slowly, and as it goes along through the year, you can suddenly divide that by the 10,000 people that you bought one this year, and suddenly your customer acquisition costs tend to be lower. So this is the way you need to look at it. Now, this all depends on how much your product costs. And the rule of thumb, so if something's more expensive, it's going to take longer to sell it potentially. That means there's a lot more effort involved. That means the costs are going to be higher. If it's something that's been sold at a lower price, again, you would expect, it's going to cost more than the product initially. But then what you're expecting within 3 or 4 months of that customer being with you, that suddenly that turns around and then you're making a profit from that person. So the major thing with when you're looking at customer acquisition costs is, first of all, has the company or the startup you're speaking to calculated everything? They've got everything in there, and are they tracking this? And what's their plan on either decreasing it or upping the amount of customers they're going to be bringing it in, so that number gets smaller to show, hey, investor, don't worry about this. We know what we're doing because we're actually tracking these numbers.
Yeah, and that, startups grappling with the two middle ones here. So customer acquisition cost so important, and it's that balanced with the lifetime value of customers that's so key, right? Startups struggle sometimes, high customer acquisition costs, and they can very quickly get out of control customer acquisition costs, because if you go on a new marketing or sales campaign, you can invest in that, and that doesn't always necessarily deliver more users or more paying customers. So that and it's that balanced against our third metric, the lifetime value, that is so important. You want customer acquisition costs to be low, obviously lifetime value to be high. And lifetime value is really difficult, talking about having to have high quality customer success, and that's something that we don't always see from startups. They're focused on getting customers in the door, not keeping them. What are your thoughts on lifetime value, and how does that need to be demonstrated to investors, Kieran?
I think you've covered it there, Alistair. You said it perfectly. It's customer success. Lifetime value, because people tend to forget the customer success kind of costs that come in afterwards, because you want to keep them clients as long as possible to show that, yes, our customer acquisition costs were slightly high, but we're keeping people for 18 months, 2 years, whatever it might be. They never leave us. And to that point, then your customer success comes in, but then you need to start taking that number away from the lifetime value to say, okay, we are spending a bit on customer success here, but look what we're bringing out to the end here.
Yeah, critical. And then the fourth one we want to pick up on is churn rate, right? And we talked then about keeping customers for a long time, the importance of a lifetime value. Obviously, letting them leaving is a disaster, right? So you spend so much time getting them in, so much cost getting them in. What's your views on the importance of churn, my friend, and how that needs to be demonstrated, or what should be tracked from a metrics point of view to make investors happy at the Series A point?
You need to be tracking your churn rate monthly to have an understanding. The big thing about churn rate is it gives you an understanding from the investor's point of view. First of all, is your customer success working? And also, is there a product market fit for your product out there? Because Obviously, if you're growing your base and people aren't leaving you, it shows the investor, hey, that this idea actually has a chance and there is a need out there for it, and we're keeping our customers in play. If the churn rate starts getting a little bit out of kilter, I'm thinking over 20% here, that would give me a red flag of thinking, hold on, there's a problem here, because they're not keeping people. Now, is that because there's no need for this product, or is it because this product isn't good enough? And if you start thinking about it, if you've got a small market, let's say the UK, now the UK is a large market, but in the grand scheme of things, it's quite a small market. And if you're only looking at a certain market and we're only selling into the UK, how long is it going to be for us to go through all our customers and we've churned everybody and the market hasn't got anybody else left in there? And what's our way of dealing with it? So the churn rate is another great indicator for me to tell me this business is actually doing what it is. Now, again, if the startup can't demonstrate to me that they're tracking this correctly, and I haven't got kind of trust in the numbers they're giving me, because it's just on a spreadsheet or a nice PowerPoint, and they just give me a number and I think, oh, that looks nice. However, when I start digging into the numbers in the background, if they can't show me where this is coming from, I'll tell you this now, I'm just not going to invest.
So thank you. That's the four. So churn rate absolutely critical. And you said something, really important just now, which is about how numbers on a spreadsheet and how it's actually shown. So we've covered off those four. You talked also about activation rates, which are important. You've got to nail these metrics and you've got to get them across, and part of that is how they're actually presented in the session, which is about knowing the audience. It's about having a story to tell that has a strong hook. It's about not reading from the slides. It's about staying focused on the benefits for the customer. There are 13 top tips that we presented in previous show that we did, and that you can get on our website or go to thesalescoop.com. 13 classic presentation tips. But I'd say in terms of investors and Series A, there's how you're presenting hard data, right? So hard growth through data. So that's about being specific with the numbers, using decimal points and making sure that the numbers are both accurate and up to date, but also very specific. You've got to pick the right measures. I mean, we've got 4 there, and you've got to mix up how you show it. 8 out of 10 versus 4x versus 79.2%. So different ways of showing metrics, so that brings out you're demonstrating growth or showing progress in the most possible way, and also the kind of soft growth. So when you're pitching to investors, it's about talking about how the day-to-day is different now, how the business has changed, how you've got a desire to catch the next wave and keep building momentum. So how those are shared is really important as well. You touched earlier, Kieran, on team structure, and I mentioned that is one of our 7 key areas that we look at, along with sales strategy, tech stack, lead generation, deal closing, customer success, and continuous improvement. And those are lifted from our 360 sales diagnostic product. We sit down for a 2-hour interview with tech startup founders. We analyze their capacity and gaps and opportunities in their sales function, and we produce a 25-page personalized report. It takes about a week to do. If you're interested in the 360 to understand where your sales function is at, whether it's ready to go for Series A money, then you can go to our website, theupliftpartnership.com/360. When I look into the comments, my friend, I see that we've been too bold. It's not been a safe enough place for anybody to ask any questions this time. So I've got one for you. If you've got a product with a much lower price point, right? Have you got any high-level tips on what you could do to reduce your cost of sale, or what should I be doing for cheaper products to get the cost of sale down?
Wow. So there's 2 ways of looking at it this way. You could have a clear sales strategy here. So if let's say you're selling something for £10, just ballpark figure, £10, subscription per month. So the major thing here is that you either have two strategies when you first start out. You either are trying to sell a lot of units to one person to show that, okay, Kieran's going to cost X and we're going to have a marketing budget and everything, but we've just sold 2,000 seats or 2,000 units to one person. And that's why we've done this. Now, that's one way of doing it. And that might be a great way of showing reduced cost of sales, because obviously I'm selling big, bulky items and I'm selling them at mass. And that's because I'm keeping my cost of sales. The worst mistake I see from companies is where they've got somebody who's expensive. Let's say you've got a Kieran yourself, and that person is selling 1 or 2 units at a time, and it costs £10 a month. It's just not sustainable. And it's just going to go. So that then has to turn into a self-service business where you're buying this without any interaction with a person, straight to the website, click, 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 credit card details in, gone. It keeps the cost of sales down nice and low. That salesperson, that salesperson that you've got who should be trying to sell the big unit could be doing other things in the company at that point. They could be doing customer success. Remember, we're a startup. We're wearing many hats. We don't wear just one hat. We're wearing about 15 hats, and depending on the minute of the day, of the moment, I've got a different hat on. I might even be wearing 2 hats at the same time. So.
Well, thank you. Big focus on B2B self-service. So we're out of time now. The last thing is for us to just talk about what's coming next. We're at Sifted Summit next week. If you're there, tap us up. Let's have a coffee. Say hello. Our next live sales scoop is on the 15th of October, Becoming a Confident Founder Seller. We're going to be talking about the evolution of the role from founder into founder seller and equipping founders with more sales skills and more sales capability. That's all. That's it for today. So thanks very much for your time, expertise and insights, my friend.
Thank you very much, Alistair.
We will